All right. Well, for our final speaker of the day, we are lucky to have Elena Mcwilliams, chair of the FDIC. Before her appointment, she was Executive Vice President, Chief Legal Officer, and Corporate Secretary for Fifth Third Bank in Cincinnati, Ohio. Chairman McWilliams is no stranger to Washington. Before Fifth Third, she worked in the United States Senate for 6 years, most recently as Chief Counsel and Deputy Staff Director with the Senate Committee on Banking, Housing, and Urban Affairs. Prior to that, as Assistant Chief Counsel with the Senate Small Business and Entrepreneurship Committee. From 2007 to 2010, Ms. McWilliams served as an attorney at the Federal Reserve Board of Governors. We always love inviting back our Fed alums. So, before entering public service, she practiced corporate and securities law at Morrison & Foster LLP in Palo Alto, California, and Hogan & Hartstein LLP in Washington, D.C. It will come. I think to no one in this room is no surprise that she graduated with highest honors from the University of California at Berkeley with a BS in political science and earned her law degree from UC Berkeley School of Law. We are absolutely delighted to have her here to close out an interesting and very thought-provoking day. And without further ado, please welcome Chairman McWilliams.
Thank you. Thank you so much. Good evening, everybody. A wise man once told me never stand between the angry mob and their food. So then I got this slot and obviously took it, so I never learned anything. I'm very pleased to join you today, and thank you very much so, President Harker, for hosting this important event on the role of fintechs. Every time people mention the word fintechs, there is an aura of science fiction to it. And yet, technology in financial services is nothing new. ATMs and mobile banking are just a few examples of the innovative services that have transformed banking in modern times. They're ubiquitous now, but they were once revolutionary. Banking has been the product of continuous innovation, going back to when the Medici Bank and its contemporaries improved the general ledger system through the development of the double entry system of tracking debits and credits or deposits and withdrawals. It is fair to say that innovation in banking has been around since at least the 15th century. What is different today is the speed and tremendous impact of technological innovation in and on banking, and the potential for technology to disrupt not just an institution or two, but banking as we know it. This is why it is crucial that policymakers and regulators understand the impact, scope, and consequences that are innate to what we have come to refer as fintechs. First, I will touch upon the role of innovation in expanding bank access, because one of the primary benefactors of innovation are customers. Mobile and online banking in particular offer a level of control, access, and convenience that consumers have embraced. If you think back a decade or two ago, very few among us could have imagined applying and being approved for a mortgage while wearing our pajamas at home. You would have to dress up and dress well to impress the bankers, and then show up at the bank with reams of paper to prove your creditworthiness. Not anymore. In fact, had my mortgage banker seen what I looked like last time I got a loan, I'm suspecting that he would have probably denied me. Consumers have embraced these technological advances. Households are using mobile and online technology to open accounts, check account balances, transfer money between accounts, send money to each other, and pay bills. And that is only the start. These transactions can be initiated from nearly any location and at any time. How many of you remember the last time you used a traveler's check? I wouldn't raise my hand, but okay. A recent FDIC survey shows that the proportion of banked households that use mobile banking to access their accounts increased from 23.2% in 2013 to 40.4% in 2017. Let me just repeat the numbers. 23.2% in 2013, and 4 years later, 40.4%. The share of banked households using online methods increased to 63% over the same time period. New technology has proven able to improve the customer experience, lower transaction costs, and increase credit availability. It also offers a tremendous opportunity to expand access to the banking system. Banks afford consumers many important benefits. These include consumer protections and wealth-building opportunities, and near and dear to my heart, the protections provided by deposit insurance. Still, millions of US households do not experience these benefits because they're either unbanked or underbanked. This number is trending down, but the FDIC's latest survey shows that more than 8 million households do not have any relationship with the banking system. Another 24.2 million households are underbanked, meaning they have a bank account but also meet some of their financial services needs outside of the banking system. Unbanked and underbanked rates are higher among lower income households, less educated households, younger households, Black and Hispanic households, working age disabled households, and households with volatile income. Overcoming challenges to economic inclusion is vital to the FDIC's mission to maintain public confidence in the financial system. Innovation plays a role here, not just in how products and services are delivered to customers, but also in the development of products and services that meet their needs, particularly those of unbanked and underbanked households. The FDIC's recent survey looked at mobile and smartphone access among these households. Results suggest that mobile and internet banking offer important inroads into the banking system. More than 8 in 10 underbanked households and nearly half of unbanked households had access to a smartphone in 2017. In addition, nearly 1/3 of unbanked households and 76% of underbanked households report having internet at home. So they may not have an access to a banking channel, but they have access to the internet. These channels enable unbanked and underbanked households to access banking services even if they're not a part of the bank branch per se. It will be up to institutions to leverage technology and develop products to reach these customers and consumers and make them their customers. As banks develop strategies to bring more consumers into the banking system, innovations by non-banks are also introducing new products and services to meet consumer demand. Marketplace lending and crowdfunding offer credit and funding without a bank's involvement. Digital-only banks partner with institutions to offer retail services, such as deposit accounts, credit cards, and financial advice, predominantly through smartphone applications. Peer-to-peer payment technology allows customers to transfer funds easily via the internet or using a phone. Robo-advisors use algorithms to provide investment advice. To ensure that we are prepared to address the changing landscape in financial services, the FDIC has dedicated significant resources to identify and understand emerging technology. We are examining trends in retail financial markets, including marketplace and digital lending, machine learning and artificial intelligence, and big data. And to the previous panel, I took your numbers. We're also considering developments in the wholesale financial markets, as well as blockchain and distributed ledger technology. Technology is not simply transforming how consumers access financial services, it will also transform the business of banking, both in the way consumers interact with their financial institutions and the way banks do business. Data analytics will improve lending and help banks develop new approaches to assess credit risk. Technology will transform how banks identify customers and how they distinguish routine transactions from suspicious activity. Artificial intelligence and machine learning will provide better opportunities to manage risk, helping banks understand how their business plan can change to promote growth while matching their appetite for risk. Advancements in technology and data analytics will also change the way the FDIC and other regulators approach oversight, particularly in the areas of Bank Secrecy Act and anti-money laundering compliance, and protecting consumers' personal information. While new technology can certainly introduce risk, it can also help regulators and institutions identify and mitigate risk sooner. And it will undoubtedly present opportunity to ease the burden of regulatory compliance. I assure you, the FDIC will keep an open mind to the potential challenges and opportunities going forward. With the potential for so much change, the FDIC is obligated to fully understand emerging technology and its implications. We have already begun partnering with banks to understand how they are innovating. We're working to identify and hire subject matter experts to deepen our understanding of technological advancement. And yes, I will be taking resumes at the end of the session. A few weeks ago, I was asked at an event in New York City what I plan to do about fintechs. I said that we plan to open up an Office of Innovation at the FDIC. By the time my plan landed in DC, there were already a handful of articles about the FDIC rolling out its Office of Innovation to the bemusement of my staffers. So to the reporters in the room, I'm taking a late train back to DC in case you're writing an article about the FDIC's Office of Innovation, and I'll be curious how many people I have hired thus far. All joking aside, it is fair to ask what the FDIC's Office of Innovation will do once it is up and running. That is, before I actually make it back to DC. I have tasked my team with 4 fundamental questions as we set out on this journey. 1, how can the FDIC provide a safe regulatory environment to promote the technological innovation that is already occurring? 2, how can the FDIC promote technological development at our community banks with limited research and development funding to support independent efforts? 3, what changes in policy, particularly in the areas of identity management, data quality and integrity, and data usage or analysis, must occur to support innovation while promoting safe and secure financial services and institutions? And 4, how can the FDIC transform in terms of our technology, examination processes, and culture to enhance the stability of the financial system, protect consumers, and reduce the compliance burdens on our regulated institutions? We will not answer these questions overnight, and certainly not before my train arrives back in DC. Adapting to advancements in banking technology is nothing new for the FDIC. Too often, regulatory agencies play catch-up with technological advances and their impact on regulated entities and consumers. The goal of our work at the FDIC is to reverse that trend through increased collaboration and partnership with the industry. We will move forward together and help increase the velocity of transformation while ensuring that banks are safe and sound and consumers sufficiently protected. As we ramp up to meet these new challenges, we have to keep in sight the potential benefits. Chief among them is that innovation can introduce safe and reliable products and services that will bring more Americans into the banking system. It is my goal that the FDIC lay the foundation for this next chapter of banking, encouraging innovation that meets consumer demand, promotes healthy and successful banks, and reduces compliance burdens. To all of you innovators out there, get to work, and thank you.
Well, we have time for some questions, but I will take the prerogative of being up here and ask the first one.
Well, thank you.
So we began the session today with several firms that are very focused on individuals, families without any credit history, limited credit history, people who can't deal with a couple of flat tires and getting to work because they don't have $400 in their bank account, if they have a bank account at all. How do you think banks should innovate around that space? And what can we, the federal regulatory system, and particularly the FDIC, do to help that?
So I'll start with a personal story. Some of you who know me, and I think some of my former Fed colleagues are in the audience, and some people from the Senate Banking Committee as well. When I first arrived to the United States 27 years ago, I came here with $500 to my name. And I remember I couldn't get a credit card because I had no job, no assets, and no income. I was a triple damaged good, right? So no bank would give me a credit card. And I can actually tell you that making sure my car is running and I don't have a flat tire was crucial to my survival. So I fully understand when people don't have access to credit services and need to get, or small dollar loans, and need to get to work or feed their baby or buy formula and diapers. So I do believe that we need to bring the banking activity in small dollar space back into banks. We regulate the banking space. We make sure that the consumers are protected. We are very careful that banks are safe and sound, and consumer protection is paramount to that effort. And for years now, I think that small dollar lending has gone to non-banks, which is fine. But again, I think more competition in that place is better. And from my personal perspective, since we regulate banks and have a good insight into how banks operate, we can protect consumers adequately if the activity comes back into the banking space. So we'll be seeking some information from the public on how best to do that.
That's great. So let me open it up to you. Questions?
I think I left them speechless.
Yes, there's
Not
right up
Nathan.
front here. Oh, here we go.
I'm pretty loud. Thank you, and thank you for being here and to the Philadelphia Fed for this great 2 days. I wanted to ask about partnerships because one of the ways in which both that market might be unlocked is through partnerships between banks and some sort of financial technology or third-party service provider. And one of the pain points that we hear a lot from within the fintech community is the sales cycle of working with banks. Banks who say they want to do a partnership, but they can only do one because the compliance of getting through that process is simply too burdensome with third-party vendor management and other regulatory check marks that they have to cross before they can onboard a partner, and then other associated challenges of partnering with an entity that's outside of the banking group itself. Do you have any thoughts about how those timetables might be compressed, or how that burden and that challenge might be addressed under your leadership?
So thank you, Nathan. We're looking for ways how we can improve the process inside the FDIC so that we can more expeditiously deliver on our mission and enable banks to partner up with innovators or innovate inside the banks. And one of the things that we're looking at is how long does it take us to process approvals. Now, from a perspective of a bank, I understand fully why it's sometimes scary to partner up with an outside entity, right? If you take a look at some of the products and without any endorsement or criticism, when Zelle was first rolled out, small banks would not sign on to it, right? They needed a large bank partner to go through the compliance framework, set everything in place, and then partner up, and then more banks kind of said, well, did the regulators, ding you for that? No, they didn't. All right, I'll sign up too. So then all of a sudden the partnerships expanded. And frankly, I think we need to provide a framework where this type of a process can happen a little bit more quickly. Because in the end, especially for smaller banks, time is money, and small banks don't have the compliance budgets that some of their larger partners do. And if they wait 10 months or 12 months or 15 months to join the same third-party provider, they're losing money. They're losing customers, and if you're used to your banking app and you have something delivered right away with a large bank, you want the same result from a small bank, and the small bank can't often deliver. So it's to the benefit of the system and the consumers if we can be more efficient inside the FDIC on how we regulate third-party vendor management processing.
I think there's a question in the middle here somewhere or so. No? Oh, right here. Right. Yep. Hot potato.
So I wanted to push a little bit on the community bank side also, and particularly their ability to compete. Certainly there's going to be some that are going to, like Cross River, that are going to do extremely well in this environment, but there's not the potential for there to be 4,000 Cross Rivers. On the other side, with Fintech now, that allows bigger banks and non-banks to compete in local markets that had previously been sheltered. And to push on one other area that probably matters, machine learning benefits from more data and having more and better people to analyze that data, which again is going to be a big challenge for small banks. So how do you see the future of small banks in an increasingly automated environment?
To be very blunt, it's difficult for small banks, right? For a number of reasons, and one of them is that they're not going to be the forefront, usually. It's hard for them to be on the forefront. They already have the economies of scale working against them. The regulatory framework for them is scaled down, but not so much that it provides a consequential benefit to them in terms of how we regulate larger banks and based on the economies of scale again. So I think it's very difficult for community banks to compete in the current environment. And then when you add to that the next layer of can they adapt quickly to new technologies, and even the next level, will they innovate inside and invest into innovation? The answer is probably no, or maybe, but not so quickly, right? So the issue for us from a regulatory perspective is what can we do to create a framework that enables small banks to either partner up with third-party providers, going back to Nathaniel's question, or to basically maybe create a third-party provider among themselves in some form by teaming up and doing some kind of a collaborative joint effort. In what ways can we enable them to partake in the digital revolution and innovation, given their economies of scale again, and how little resources they have to dedicate to innovation in particular. So it's something we're cognizant of. How many of you have driven across the United States, actually gotten in the car? Okay, so quite a few. So if you know, I've done this and it's fascinating. So there are places in the United States that if you drive for 2-3 hours, you don't see a new community, right? 2-3 hours, you don't see a new community. And so we have, from the regulatory perspective, we have to wonder what happens when a bank in that small town closes down, right? Out of 3,100 counties in the United States, more than 600 have a single banking presence. So the question is, that customer in that small community expects to digitally deposit a check because that's the market expectation now, right? And how is a small bank going to provide that type of a customer service and technology and still remain competitive? And that's something from the regulatory perspective we need to be highly sensitive to and cognizant of as we shape the framework and allow banks to partner up.
So maybe time for one more question, if there's one more question. Yes, right in the front here.
So I think we heard earlier today, quite eloquently, that the rate of change is increasing, something that I very much agree with. Regulatory cycle times in terms of regulations, exams, and of course some folks are talking about regulatory technology or reg tech. What do you see the FDIC doing in terms of working to increase or shorten those cycle times for the release of regulations, examination, supervision generally?
To be very blunt, I have asked staff to kick it into high gear. We need to be more efficient in how quickly it's hard for a regulatory agency to lead, right? So we need to be more efficient in how quickly we can follow and hopefully keep at the same pace as innovation is in terms of how we regulate. And the reason for that is that if you don't, a lot of the activity that banks would have otherwise engaged in and would have serviced and served customers very well ends up not being done by the banks, right? And then it goes outside of the banking sector, which again, it may be okay, it may not be okay, depends on your position and how you look at the system. But by minimizing systemic or reducing systemic risks at bank, we're not necessarily reducing systemic risk in our financial system, right? So it's better for us to team up right up front with our regulated entities and partner up on, hey, do we understand what you're doing? And just because it's new and different, it does not mean it's bad, right? So we need to reframe culturally how the agencies look at innovation and enable entities to innovate in a safe and sound manner. Again, we don't want banks to not be safe and sound. We don't want banks not to be regulated well or managed well. But again, times are changing and we need to adapt.
Well, please join me in thanking Chairman Mcwilliams.